Welcome back to Metal Market News. I'm Professor Harry, and as an independent analyst, my goal is to cut through the noise and give you a grounded, strategic perspective on what's really happening in the precious metals market. Today, we're looking at a narrative that challenges conventional thinking, particularly the relationship between gold, silver, and broader financial markets. What you're about to hear isn't just a surface-level observation. It's a structural argument about where value is shifting globally. I'll break this down step by step, not just presenting the original analyst's perspective, but also weighing it against my own analytical framework so you can understand both the strengths and the limitations of this thesis. The first major point being made is that silver is historically undervalued relative to gold, currently sitting around 1% to 1.5% of gold's value, with expectations that it could move toward 3% to 6%. Now, from a purely historical ratio standpoint, this argument carries weight. If we look back to 2011, the silver-to-gold ratio did indeed spike above 3%, reflecting a period of speculative excess combined with strong monetary demand. The analyst is essentially suggesting mean reversion, that silver will eventually catch up to gold in relative terms. However, what needs to be understood here is that ratios don't move in isolation. They are driven by liquidity cycles, industrial demand, and investor psychology. While silver is both a monetary and industrial metal, its volatility is significantly higher than gold's, which makes it more sensitive to economic slowdowns. My view aligns partially with this argument. Yes, silver is undervalued on a relative basis, but expecting a straight move back to 3% or higher assumes a liquidity-driven bull cycle similar to 2010-2011. Without that level of speculative inflow, the adjustment could be slower and more uneven than implied. Moving deeper into the analysis, the discussion shifts toward price targets, specifically referencing a potential move in gold toward 5,300 and silver reclaiming levels above 90. This is where the argument becomes more aggressive and, frankly, more speculative. Price targets like these are often derived from technical projections or long-term macro models, but they require a strong catalyst, typically a breakdown in fiat confidence or a major shift in monetary policy. The mention of momentum as an early signal is valid. Momentum often precedes price and trend reversals. However, relying too heavily on momentum without confirming macro conditions can lead to premature conclusions. From my standpoint, while the upside potential exists, especially in a prolonged inflationary or stagflationary environment, these targets should be treated as scenario-based projections rather than base case expectations. Markets rarely move in straight lines, and such dramatic upside would likely come with significant volatility and interim corrections. Another critical argument presented is the idea that gold does not necessarily fall when equities fall, challenging a widely accepted belief in financial markets. Historical references to periods like 2000 and 2007 are used to support this claim, and this is actually a very important insight. During transitional phases, when markets move from expansion to contraction, correlations often break down. Gold in these moments begins to act as a hedge against systemic risk rather than simply following liquidity trends. I agree strongly with this perspective, but with an important nuance. In the initial phase of a market crash, gold can and often does decline due to liquidation. Investors sell what they can, not just what they want. However, once that forced selling subsides, gold tends to recover and outperform as confidence in traditional assets erodes. So the statement isn't entirely wrong, but it lacks timing precision. Understanding when gold decouples from equities is crucial, and that requires a deeper look at credit markets, central bank responses, and real interest rates. The analysis then moves toward investor behavior, particularly the tendency to focus on short-term movements rather than long-term trends. This is a point that cannot be overstated. Most market participants are driven by headlines, reacting to daily price swings without understanding the structural forces at play. The reference to Michael Oliver's perspective reinforces the idea that momentum and long-term trend analysis are far more valuable than short-term noise. I fully agree with this, but I would add that even long-term analysis must be dynamic. The past decade has shown us that markets can remain irrational for extended periods, especially under heavy central bank intervention. The claim that gold, silver, and mining stocks have quietly outperformed or maintained resilience relative to the S&P 500 is partially true, but it depends heavily on the time frame and the metrics used. In nominal terms, equities have significantly outperformed metals over the last decade. However, in relative and risk-adjusted terms, metals have indeed shown resilience, especially during periods of stress. This distinction is important because it shapes how investors allocate capital. Finally, the argument culminates in a technical perspective, highlighting a decade-long base formation in gold and related assets relative to stocks, followed by a recent breakout. This is perhaps the most compelling part of the entire thesis. Long-term base formations often precede major trend shifts, and a breakout from such a structure can signal the beginning of a sustained bull phase. The key phrase here is early stages, which suggests that the move is not yet overextended. From a technical standpoint, this is a bullish signal, and I do see merit in this interpretation. However, technical breakouts must be confirmed by macro fundamentals. Without supportive conditions such as declining real yields, currency instability, or increased geopolitical risk, breakouts can fail. My view is cautiously optimistic. The structure is indeed constructive, but confirmation is still needed. Investors should not blindly chase the breakout, but rather position themselves strategically, understanding that long-term trends take time to fully develop. The broader implication here is that value may be shifting away from traditional equity markets toward hard assets, but this transition will likely be gradual and accompanied by periods of doubt and volatility, which is exactly where disciplined investors find their edge.